Iron Financial. We're here to help you forge a stronger portfolio and cut right through all that market weakness. I'm your lead analyst. Today, we've got a really tough question on the table. Union Pacific. You know it, a titan of American industry. But is it built to last, or is this thing about to go off the rails? Look, this is way more than just another earnings review. We're doing a full-blown financial stress test. We're going to get in there, check the steel beams, test the concrete foundation, and figure out if this company is as solid as it looks, or if it's starting to crack under pressure. So just take a look at this. I mean, that's not just a train, that's the lifeblood, the circulatory system of the entire American economy. You're looking at pure, raw power. Thousands upon thousands of tons of steel moving the goods that make our country run. When you think of Union Pacific, this is the image that comes to mind, right? An unstoppable force, a fundamental piece of our industrial might. This picture just screams durability, strength, and that relentless push forward. It's basically the physical form of a blue-chip stock. Whoa, hold on. Great picture, I get it. But we're not buying postcards here, right? We're analyzing a stock. I'm the Market Skeptic, and my job is to cut through all that hype. That image, yeah, it's screaming power. But does the balance sheet scream power? Is the financial engine really as mighty as those locomotives pulling all that freight? Or are we just looking at a beautiful facade that's hiding a structure under some really serious strain? That is the real question we need to dig into and answer today. He's absolutely right. And to do that properly, we need a plan, a rigorous, structured approach. We are going to break this company down, piece by piece, to find the real answer. So first up, we're going to tackle the accounting games, that whole GAAP versus non-GAAP puzzle. What are the numbers actually telling us? Then we'll drill right into the latest quarterly performance. We're looking for immediate signals. Is the company picking up speed or losing steam right now? After that, we're heading deep into the engine room, debt and cash flow. Is there enough power being generated to keep this whole thing moving forward? Then we'll look at their own crystal ball, the company's guidance for the road ahead. What are they telling investors to expect? And finally, we deliver the iron financial verdict. Is this an opportunity or is it a trap? Let's get into it. Okay, let's start with the books because, this is where companies really try to control the story. We almost always see two sets of numbers, right? You've got the official, by-the-book, GAAP numbers, and then you've got the company's preferred version, the adjusted or non-GAAP story. The first question every single investor should be asking is, what exactly are you adjusting and why are you adjusting it? What are they trying to show you? Or maybe, more importantly, what are they hoping you just gloss over? Now, to be fair, this isn't some shady back alley thing. It's standard practice. The whole idea behind non-GAAP is to strip out things like one-time events or weird non-cash expenses, all to give investors what's supposed to be a cleaner look at the core business, the repeatable operational performance. It's a tool to cut through the noise. But you know the saying, the devil is always in the details. The definition says they exclude stuff to show ongoing performance. So the skeptic in me immediately wonders, okay, what are you deciding is not ongoing? And boom, here it is. This is a perfect example of why you've got to read the fine print. Now, what's so fascinating here is that the adjusted number, the one that's supposed to be the cleaner, better version of their performance, is actually lower than the official GAAP number. So adjusted earnings per share for 2025 comes in at $11.66. The reported number, $11.98. That's a 32-cent gap. So where'd it go? Well, you just have to look at their own reconciliation table. They added back 12 cents for acquisition-related expenses. Okay, that's normal. But then they subtracted 32 cents for industrial park land sales. Just think about that for a second. They sold some land, booked a nice profit to make their official GAAP earnings look bigger, but then they turn around and tell us to ignore that profit when we're judging their core performance. Come on, you can't have it both ways. It's a deliberate choice to show a rosier official number while kind of admitting that the underlying business is actually a little less profitable. That's a fantastic point. And that little accounting move is a really crucial piece of this entire puzzle. Okay, so now let's move on. Let's look at the most recent quarter, Q4 2025. This is where we should see the real current momentum of the business. I'm looking for hard evidence that the core operations are just firing on all cylinders, that they're providing a solid foundation of performance as we start the new year. These quarterly numbers should be the proof of their underlying strength. So let's pull up the income statement for Q4. At a quick glance, the numbers, they look pretty decent. We're seeing some positive movement up and down the statement, but I want to pull your attention right to the bottom line. That's net income. This is the big, flashy headline number that always grabs the market's attention, and on the surface, it's telling a pretty positive story. And this right here perfectly illustrates my point, a 5% increase in net income year over year. They brought home almost $1.9 billion in just 3 months. That is a strong, solid number. Let's be real. In a tough economic environment like this one, growing your bottom line by 5% is a very clear signal of profitability and solid operational execution. To me, this is a load-bearing wall in the company's whole financial structure. It's solid. A load-bearing wall? I don't know. I'm seeing a pretty significant crack forming in the foundation. That nice net income number you're pointing to, it's hiding a really serious problem. Their efficiency is getting worse. Just look at the operating ratio. For any railroad, this is one of the most critical metrics there is. It's just operating expenses as a percentage of revenue. Lower is always better, and Union Pacific's ratio went the wrong way. It climbed from 58.7% all the way to 60.5%. Plain and simple, it is costing them more money to generate every single dollar of revenue. That is not a sign of strength. It's a clear sign of operational strain. And let me just pile on here because it actually gets worse. So how did they even grow revenue if their efficiency was getting worse? Easy. Price hikes. Because they sure as heck weren't moving more stuff. Freight volume, the actual physical amount of goods they hauled, was down a full 4% in the quarter. So the real story here is that they're charging more to move less, and it's costing them more to even do that. That is not what I would call a high-quality growth story. That sounds like a company that's struggling with core demand. Okay. The quarterly numbers clearly present a mixed bag. I will absolutely concede that point on efficiency. But quarterly performance can be noisy, right? There are always ups and downs. So let's zoom out. Let's look at the full year results. This will let us see past any of that short-term turbulence and really assess the integrity of the entire structure over a much more meaningful time frame. The full year performance is what's really going to show us the company's resilience and its strategic execution. See, now this is the bigger picture. When we step back and look at the full year, the story becomes much, much clearer and a lot more positive. Let's just focus on the reported official GAAP numbers for a second. Net income for the entire year was up 6% to over $7.1 billion. And look at the earnings per share, up a very strong 8% to $11.98. This isn't just one good quarter. This is sustained profitable growth across 4 straight quarters. This is what a robust annual performance looks like. And you don't have to take my word for it. The CEO, Jim Vanna, says it himself. This isn't some happy accident. He directly credits this performance to their focus on strategy and on delivering value. The company is telling us straight up that their plan is working and it's leading to record performance. When you see full-year growth like this and it's backed up by a clear strategic vision from the leadership team, it paints a really compelling picture of a well-managed, durable company. A compelling picture, or maybe a carefully crafted narrative. I mean, reported earnings and CEO quotes are one thing, but they don't tell the whole story, not by a long shot. If we want to understand the true durability of this company, we need to get into the engine room. We have to analyze the cash and the debt. Is this company's engine actually generating enough raw cash to power through any economic headwinds? Or is it just burning through fuel faster than it can take it on? Remember, profits are an opinion, but cash is a fact. So let's get right to the facts. This table right here, it reconciles Union Pacific's free cash flow. This metric is the absolute lifeblood of any company. It's the cash that's left over after you've run the business and paid for all your new equipment. This is the money you use to pay dividends, to buy back stock, to pay down debt. The direction this number is heading is, without a doubt, absolutely critical to our analysis. And the direction is down, sharply. I mean, this chart makes it painfully clear. Back in 2024, the company generated over $2.8 billion in free cash flow. Fast forward to 2025, and that number plummeted to just under $2.3 billion. That's a drop of over $500 million in a single year. This isn't some small dip. This is a significant weakening of the company's core financial power. This is a potential structural weakness that you simply cannot afford to ignore. And honestly, it gets even more concerning when you start to look at their efficiency. Remember those great net income numbers we were just talking about? Well, it turns out the company is getting worse at actually turning those reported profits into cold, hard cash. Their cash flow conversion rate dropped from a very healthy 87% in 2024 all the way down to 77% in 2025. This is a huge red flag. It tells you that the quality of their earnings is actually going down. The profits on the page aren't turning into cash in the bank nearly as effectively as they used to. I see the cash flow numbers, I do, and they are a point of concern. But you're missing the bedrock. You're missing the absolute foundation of the company's financial health, its debt management. Take a look at the adjusted debt to adjusted EBITDA ratio. It's stable, rock solid at 2.7, exactly the same as the year before. What this tells us is that despite any short-term cash flow fluctuations, the company's debt level is perfectly manageable compared to its core earnings power. They can comfortably handle their liabilities. This is the governor on the engine, making sure the company doesn't get over-leveraged. This is what financial discipline looks like in action. That stability is absolutely crucial. A well-managed debt load gives you a strong foundation you can build on. But what are they building towards? Let's look to the future. The past is the past. What really matters for investors now is the track ahead. The company's own guidance for 2026 should give us a pretty clear view of the opportunities and the challenges that are waiting on the horizon. This is where we look for the real signals of future growth. Okay, but before we even get to what the company thinks its volumes will do, we have to look at the economic environment they're steaming into. And frankly, it looks like a major slowdown. S&P Global is forecasting that industrial production, that's the measure of output from all our factories, mines, and utilities, is about to slow to a crawl. They're predicting just 0.1% growth in 2026. Let me be blunt. How does a railroad, a company whose entire business is moving the goods of the industrial economy, possibly thrive when the industrial economy itself grinds to a complete halt? You're just focusing on the macro headwinds. You're ignoring the micro tailwinds and their proven history of navigating these kinds of cycles. The company is clearly identifying pockets of strength. Look, they see positive volume growth coming from coal and renewables, from grain, and from industrial chemicals. These aren't small categories, and they often carry very high margins. They are actively out there winning new business and capitalizing on planned expansions. This shows they know how to navigate a complex environment and still find profitable growth. But look at what's in the red. Forest products are down. That's weak housing demand. Intermodal is down. That's fewer international imports. Automotive is down. That's softer vehicle sales. These aren't little niche categories. These are pillars of the U.S. economy. Finding a little profitable growth in a few select areas doesn't change the fact that the very core of their business is tied to major economic trends that are flashing bright red warning signs. A few green shoots don't make up for the fact that a huge part of their forest is facing a serious downturn. All right, we've looked at this from every possible angle. We've seen the solid headline numbers, but we've also seen the troubling details hiding just beneath the surface. We've acknowledged the strong brand and the powerful imagery, but we've also seen the weakening cash flow. We've noted the pockets of growth and the pretty significant economic headwinds. So now it is time to put it all together and deliver the iron financial verdict. Is Union Pacific an opportunity to buy a durable American icon at a good price? Or is it a classic value trap waiting for unsuspecting investors? So here's the bottom line. Union Pacific's core operational foundation is, without a doubt, solid. This is a behemoth of a company with an incredibly powerful franchise. But its financial armor is showing some very clear stress cracks. You've got the slowing industrial economy, the declining freight volumes, that worsening efficiency, and most critically, that weakening free cash flow. All of these are significant warnings. The strength is definitely there, but so is the strain. And that leaves us with the final and most critical question for you to think about. This company has the muscle, it has the history, but with these powerful economic headwinds gathering strength, is that operational muscle going to be enough to keep this train on its tracks, or will all these financial pressures ultimately lead to a derailment? That's the risk, and that's the opportunity that you have to weigh. So think very carefully before you decide to buy your ticket.